Okay, so welcome to our weekly educational webinar. My colleagues Mahesh and I would like to thank you for joining. After holding a series of webinars tackling technical analysis, we chose to introduce to you another school of analysis, which is the fundamental analysis. So first we are going to start with a brief explanation on what is fundamental analysis, and then move forward with explaining the economic indicators, economic calendar, top economic indicators, and after that Sai will talk about the role of central banks and show you some impact on the market following news releases, and finally pinpoint some key matters to follow up closely in the coming weeks. So in general, fundamental analysis for stocks is when you analyze the financial statements of a company, the overall state of the industry, assess the company's competitors. But when it comes to currency trading, it's a little bit different. It is everything that has to do with the economic activity of the country, politics, security, and safety. So usually market participants will be looking at economic data reports and news headlines that are set to affect the investors' attitude towards buying or selling a certain currency. So usually if the overall state of the economy is strong and the economic activity is healthy, investors will look after opportunities in this country and drive their investments there, which would add a demand for its currency, leading to appreciation and vice versa. If a country is not doing well economically or has some serious political problems, even local investors will run away and transfer their money towards countries with better status. So this outflow would lead to a depreciation in the currency. So traders, they would start analyzing this the whole state, or what's happening, or these actions that are taking place, and trying to find opportunities from these actions. So traders can benefit usually from small trades on the releases of certain economic indicators. However, the good trade, it is like building a puzzle. You start assessing different parts of the economy, how they are performing, by following up the progress of economic indicators of different categories. We'll pass by the categories in a while, and base your assumptions on trade and trade. So analysts believe that the current price of a security may be incorrect, but the fair price will eventually be reached. So economic indicators usually they fall under 5 categories. Mainly there are inflation, economic activity, employment, confidence, and central banks. So where do we usually get these economic releases or economic indicators? They are found in what we call the economic calendar. So mainly most of the websites that has to do with trading, either brokers or websites that post news about trading or economic news, they have their own economic calendars. Also, if you have our Telegram channel, we post the economic indicators as soon as they are published. So let me show you an example of an economic indicator. So on each economic indicator, economic calendar, you can set your settings, what indicators to follow, indicators that affect which currencies. So if you trade the euro, I just want to the euro against the dollar, let's say, I just want the indicators that can affect the euro and the dollar alone. I don't want to look at indicators that do affect the Australian dollar, for example. Indicators that usually have high impact. So if for example, you are trading the news at the moment, so you believe that you wanna look for indicators that have high impact on the market. So you can choose the importance of the economic indicators that you are following. So here you can see at the top left we have the time, the current time, and then here we have 7 columns. The first one shows the time when the news will be published exactly. So if you set the time, let's say in GMT, so you're going to have the time in GMT. So if you set it based on your country time zone, you'll have it in your country time zone. The second column is the currency. So for example, this event will affect the Australian dollar. The other event will affect the euro. The other event will affect the British pound, the dollar. So each event has an impact on a certain currency. The third column is the importance of this economic event or economic indicator released. Ranging from low to medium and high impact. So here you can see 3 bulls. 3 bulls means that these economic indicators or releases, they have high impact on the market. If they have medium impact, you'll see 2 bulls only, and if you see low impact, you'll see one bull only. So this is for the importance of importance. 4, we have the event itself. So it's either a release of an economic indicator, it's either a central bank meeting, maybe G7, G20 meeting, so major currencies, maybe OPEC meeting. So it depends on the event that is taking place. It will be shown. Now let's move to the last column. These economic indicators, before moving to the last column, these economic indicators, they have a certain calculation basis. So for example, they are calculated, they are published monthly, or they're calculated month over month basis, quarter over quarter basis, year over year basis. Here, if you can see the GDP quarter over quarter, it is measuring the change between the previous quarter and the next quarter. Some of them is year over year, some of them it's month over month. It depends on the economic indicator. And also here you can see, for example, the German unemployment change. This is for May, so this is for the past month. It's showing the past month. Here retail sales month over month in April. So this is the retail sales in Australia in April. So now by moving for the last column, it is the previous reading of the previous release. This forecast, it is the forecast done by analysts, by many analysts, so they have certain consensus on the market. So this is the median forecast, and the actual will be placed as soon as the time, the release time is reached. So this is for mainly the economic calendar. This was for yesterday and today. Here's the progress a while ago. So we had here the actual reading was exactly as forecast. Here the reading was higher than the forecast, and here also it was higher than the forecast. In red, it means that it's bad for the currency. In green, it means that it's good for the currency. So here to monitor, we're going to explain each of these economic indicators in a while, so don't worry about it. So now let's explain the top economic indicators. As I mentioned, they are in 5 categories usually. So let's start with inflation. Higher inflation means that we are losing the value of our money, but also weak inflation or deflation means that there is no demand, which also has some catastrophic effects on the economy and on our everyday life. So what are the top economic indicators to follow on inflation? The consumer price index. It is the measurement of change in price level of a basket of goods and services that the consumers purchase. So we have also the core CPI, which doesn't take into consideration the price of food and oil. Usually a healthy inflation levels, they are between 2 and 3%. So usually central banks do aim at having inflation targets between these two levels. So this is considered healthy inflation. So sometimes if the central bank sees inflation is going high, it won't be it will be disastrous for the consumers, so they have to take action. And also if the consumer price index or the inflation is going down, it will also have certain impacts on the economy. So also central banks will have to adapt the policy. So I will talk about this later. So also now we have the producer price index, which also measures the change in prices received by domestic producers for their output. This would affect the consumer price index, which these products are in the market for selling. Since, for example, if we're taking the certain prices that the producer is paying in order to produce an item, and when this item is in the stores later, it will have an impact on our on the prices that we are paying. So for example, if the producer is paying higher prices, definitely the product will be more expensive, which will also be have some impact on our spending. So this is for the producer price index. Also there are commodity price index, which is usually followed by in countries that do import a lot of commodities or rely on commodities. Services price index also measures the change in prices in services. Imports price index also is similar, change in prices in imports, and the house price index also measures the change in prices of housing. So this is about inflation. Also there's the personal consumption expenditure. It is also followed by the Federal Reserve in order to check to aim for inflation. So these are the main economic indicators to follow up for inflation. Economic activity, which is the second category. It has a lot of economic indicators that do show us the performance of the economy or the economic activity. First, among the most important indicators, the GDP, the gross domestic product, which is the monetary measure of the market value of all the final goods and services produced in a specific time period in a country. So everything that's happening in a country, everything that all the goods and services that are being produced that will be measured. So when it is higher, it means that the economy value is growing, and vice versa. When we see a drop in GDP or a negative GDP, it means that the value of the economy is contracting, which isn't good. Usually, increasing GDP change is good for stocks. So when for example your economy grows by 3%, 4% quarter on quarter, this could mean that the economic activity is very good and companies are being more profitable, so this will drive stocks higher. Retail sales is also another key indicator, which is a good pulse for the economy. It measures the amount of goods and services sold to consumers. So as long as sales are expanding, the economy is in better shape, and vice versa. So for example, here what currently happened due to the COVID-19 outbreak, where we saw in different countries around the world, retail sales are plunging or collapsing by around 15, 20, 25%. This means the profitability of the companies are less. So it has an impact on the price of certain stocks, and also it would have an negative impact on certain currencies. The industrial production is an economic indicator. For first, durable goods orders reflects new orders placed with domestic manufacturers for delivery of factory hard goods in the near-term future. It is also a good measurement for the performance, but usually we do look out for durable goods orders when the economy is already doing well. So since durable goods, they aren't always in demand. Industrial production, it is an economic indicator that measures the real production output of manufacturing, mining, and utilities. So also in order to follow up on the changes in these sectors, so we have to keep up with industrial production. A better reading is always good. So high reading and expansion in industrial production is good, and the contraction in industrial production is bad for the currency. The PMI, or the Purchasing Managers Index, it is based on a monthly survey sent to senior executives at more than 400 companies, usually depends on the country, in 19 primary industries. So they are about the services, manufacturing, and construction sectors. So we have the PMI for services PMI, manufacturing PMI, and construction PMI. It is usually based on 5 major survey areas: the new orders, the inventory levels, production, supplier deliveries, and employment. Usually above 50 reading is very good reading for PMI. As long as we go higher, above 50, it is very good. We are in expansionary phase, and when activity drops, so what's similar to what happened during the coronavirus, we saw some PMIs, for example, services PMI in the Eurozone dipped to 11. It's meaning that the activity in the services sector is almost stopped, so it was bad for, it showed that the economy is suffering. So this is for the Purchasing Managers Index. Trade balance is everything that we import and export. It's the difference between them. Home sales, as long as we are having higher home sales, so the country is, the economy is performing better, people are being able to buy new homes, and when they aren't able to buy new homes, it means that the consumers are suffering. So it always gives us a hint about the performance. Building permits, and which are the permits given by the government in order to build the new houses. So usually when there are higher building permits, it means that home builders, they are expecting higher sales, so it's always a good indication for the housing market. Business inventories, when business inventories drop, it's good for the economy, since it measures the inventories that are left out at companies or at factories. So always when we have less business inventories, it's better for the economy. When we have higher business inventories, it means that the economy is a little bit slowing down. So this is for the economic activity. Let's move to one of also of the major categories, employment. We have also certain indicators. Of course, you've heard a lot about the jobless claims, unemployment rate, non-farm payrolls. So these are all give us insight about the performance of the labor market. So first, the unemployment rate, which is the number of unemployed people as percentage of the labor force. So of course, lower unemployment rate is good. It means that the economy is performing better, and the higher unemployment rate is bad for the economy. Participation rate is the number of people working or actively seeking work as a percentage of the working population. So usually we have to focus on this one because usually it drops following crises like the one that we witnessed in 2008, 2009, and also currently participation rates are dropping around the world. So this is one of the also indicators to look out for. Initial jobless claims is the weekly jobless claims filled in the United States for those who have who are unemployed, which exceeded 40 million in the past couple of weeks. Employment changes uh, in employment availability or in jobs, so higher employment change, it's always better. And as long as we see a drop in employment change, it means that the labor market is suffering. The jobs opening, non-farm payrolls, it's one of the most important reports followed by investors. Usually you have a high volatility in the market when these numbers are released. Usually they are out every first Friday of the month. So non-farm payroll employment is a compiled name for companies in the United States. It doesn't include farm workers, private household employees, or non-profit organizations. It represents around 80% of the U.S. workforce. That's why it is very important. And farmers are excluded from it due to seasonality. So this is for the non-farm payrolls. So usually when we see better or higher numbers in the payrolls, it means that the economy is creating more jobs. And when we see a negative reading or a drop such as the ones that we were witnessing for the past 2 months, it means that the economy is losing jobs. So last month the US economy lost, in April it lost around 20 million jobs, and currently they are expecting around 3 million jobs lost in May. So keep tuned on Friday to follow up on the latest non-farm payrolls. ADP non-farm employment change. It's a private survey that could signal what are the official numbers on the non-farm payrolls. It's always released 2 days ahead of the non-farm payrolls, usually on Wednesday at 12:15 GMT. And the average earnings index, it also has to do with inflation, since usually when the earnings of employees are higher, they will have the ability to spend more. So higher spending will also be positive for the economy. So they are also released as a part of the jobs report. Confidence is very important in terms of economics, because we are living on the financial sector, and the financial services that are based on confidence. So when investors have higher confidence in a country or in a sector, they would invest more in it. Also, consumer confidence is very important, since if you're not confident, if you don't have enough confidence in the current economic activity, you won't be spending, you would be looking for saving more. And if you're saving more, some businesses could suffer. IFO business climate, it's very well-known survey in Germany that measures the economic activity. Also, the ZEW sentiment measures activity of the sentiment of the German investors and businesses, and also the Eurozone as a whole. And any business surveys, they are well known in Australia and New Zealand, so they are available everywhere. And Centex investor confidence is for the Eurozone. It's always better to have better confidence or higher reading and confidence levels. It's always better. So as you can see, it's a spiral. Everything is dependent on the other. So for example, it starts with your decision whether you go to the malls or to a certain shop. If you decide to buy something, it means something for the economy, and if you refrain from buying something, it will also mean something for the economy. For example, if you went to a store to buy a certain product, but you refrained for a certain reason, this miss in sales, it will lead, for example, if it's a mass act or a mass action, it will lead to less profitability in the store itself. So when the store is suffering, we will have more layoffs. If we have more layoffs, unemployment will be higher. Also, the factories will have less orders, so the factories also will face troubles. They will have also layoffs, or they will give less salaries, so other people also, they won't be able to spend more. Less spending is also negative for the economy. So it's all a spiral. It's all built on each other. On every action accounts and economic model. So these are the top four economic indicators category. Now I'll leave you with my colleague Sai. He will talk about central banks and the role of central banks. He will also explain the impact of some economic indicators on the economy. Sai?
Thanks, Wael. Hello, everyone. This is Sai joining with you. Very good. It was a great explanations from Wael. Next, we'll move on to the next topic. It's central banks. So obviously, it's one of the major factor on a fundamental analysis when talking about the central banks. So we say central banks are responsible for overseeing the monetary system for the nation, or we can say for any country. However, the central banks have a range of responsibilities for overseeing monetary policies to implement specific goals such as currency stability or lower the inflations or employment, as Wael was talking about the employment and inflation pattern. So central banks also generally issue currencies, functions as well as the bank of the government, regulate the credit system as well. Now it manages the exchange reserve. That's one major thing. So when you see from the picture, so it's all controlled. The central bank entirely controls the entire systems basically. We said the interest rates. So any central banks, any country are responsible to set the interest rates. Where you're going to see what is updated about the central bank's rates on the coming slides. Aim for macroeconomic targets. And you can say issue notes and coins, and then for the resort of banks, ensure the financial stability, which I was talking about, targets, promotion, growth, and employment. So which all central bank has a major role plays in any. That depends. All the currencies rates have been depend on the central banks. So when you move on to the next slide, so we can see there, these three factors are the major correlation with the central banks. First, we can say the open market operations. So interest rates and reserves. So reserves also plays a major role how the central banks, other banks with central banks have been correlated, how the reserve have been kept. So now we're going to see one by one with a small explanations to understand on the point of view. So let's move on to the open market operations. If you say open market operation, generally it says bonds or something like this. It is the action of buying and selling bonds on the open market in order to regulate the supply of the money. So this open markets operation, which really has a regulate which supply, which lower the money or higher the money, so that way actually. When central banks buy bonds, for example, any central bank, for example, Federal or European bank or Japanese bank or Bank of Japan, are trying to buy some bonds, that means their money flow is getting higher. That means whenever the central bank buy bonds, they are increasing money supply. And when they are selling the bonds, that means they're selling out from the bond, they are decreasing the money supply. So this is a major role which central banks plays on the bonds. So this actually it's an asset purchase, makes loans easier to obtain and drive down the rates. So selling assets makes loan more expensive and increase the rates. So basically this open markets bonds buying and selling, which correlation of any type of money markets, where the central bank stands. It shows you if you have more purchasing power with the bonds, it's understood that there are more liquidity happen in the markets. And same way when they are selling on the bonds, therefore the money is going out from the markets, the foreign investors, so foreign investment bank. So basically all type of central bank act mostly on this way. So when you're coming to the next part, interest rates, is a very important where we have to focus on this. So everyone knows about, we all focus on interest rates, basically that's remove the market, it's move the volatility of the market very drastically. So when you come to the interest rates are one of the most important drivers of the financial markets, because it's decide the rates of any economy or any country. So central banks use interest rates to manage economy. That's what I was saying. So it's a major role plays on here. So interest rates can be raised to curb inflations and lower to stimulate the economy. So where to raise the inflation, curb the inflation, as well to lower the stimulate of the economy. So it's stabilize the economy entirely by giving the interest rates. So higher interest rates usually result in appreciation of the currencies. For example, if you see any central banks rising the interest rates, for example, Fed or Euro or JBP or GBP or any type of central bank, if they are hiking the interest rate, obviously the appreciation will be there in the currencies. When they are lowering the interest rates, then there's a depreciation happens in the currencies values. So these are basic conditions, basic scenario, but there are terms and different in case of conditions and different than inflation. Sometimes they increase the interest rate, but still the currency is still weaker. So they're forced to act to increase or to cut the interest rate. If you see continuously last 1 year of time, most of the central bank has been cutting the interest rate due to the inflations, due to many reasons have been in the markets. So when you say the interest rates, basically, so let me show you. Tell you the interest rate, what exactly its affect. So major mechanisms of the central bank regulate with this levels of interest rates. For example, like you are when the rates are come down, the investor always typically to save money, right? When the interest are make high, they increase the high. When the investor typically to save money to earn some interest on the money. So borrowing the money is expenses for them when they increase the interest rate. When it coming to the lower the interest rate, it's cheaper to borrow the money. So this is how exactly the difference of the difference between the cutting the interest rate and hiking the interest rates. So let's move on to the next. We can see central bank rates. So this is the updated central bank rates are being shown here. For example, you can see the Federal Reserve has 0.25%. European Central Bank, it's almost 0.00. Bank of England has 0.10%. Swiss National Bank is minus 0.075. Japanese Bank of Japan also have minus 0.10. Bank of Canada has 0.25%. Reserve Bank of New Zealand has 0.25. And Reserve Bank of Australia has 0.25. If you see the correlations of each and everything, if you see compared to the last couple of years, it's every central bank has reduced the cut the interest rates drastically. So the borrowing will be cheaper. The buying pressure will be lower. For example, if you're correlated with the Japanese and Canadian dollar, for example, so CAD versus Japanese, and if you're talking with the correlation with the Japanese and Canadian dollar, and if you want to buy a Canadian dollar, obviously when you are in a buyer mode of more, that's you get a more interest. So though the expenses will be more, but still the interest will be more on the buying side because the Bank of Canada has a positive interest rates. When you're talking about the Japanese end, you get cheaper rate to buy on it, but you have the negative rate of interest rate cuts. So this interest rate plays a very major role when it coming to the markets and play on the financial sustainability of any country. So let's move on to the next one. So where the third topic was like reserve. So this is also very important when you're talking about the operations, open market operations and the interest rates. Next, coming to the reserve requirement for ratio. Reserve requirement are the amount of cash that bank must have to be sent to that central bank. That means should have enough reserve to sustain stability of the economy. So that makes, because even this type of risk news release every time. In a couple of weeks or monthly basis, basically a monthly basis report comes on out for the report. So this understand how the stability of the particular central bank to control the stability of the economic. So bank must hold this reserve to ensure the ability to meet the liabilities in case of any sudden withdrawals. In case of any withdrawal happens, any fall in the markets, any fall in the economic, when for example take for COVID-19, so this also a major impact happen in all the countries economically. It been drawn out, many type of business been down. Many growth of the conference business have come down. So they have to have enough money. Banks should have enough reserve to ensure the ability to keep the liabilities on the side. So these are the sudden withdrawals, sudden things happen in the economy, so have a subsidy. So reserve plays a major role for any central bank to support the banks and support the economic. So central bank use this tool to increase and decrease more supply. So obviously, like this is a major tool where it increases supply or decrease tool as a tool to understand the money supplies. So when reserve requirements are less, the banks have more money to lend and vice versa. Exactly, I was saying about when there is a requirements are very less, definitely they have more money to lend, as well as on the other side, when they have more requirement, their banks have money to be borrowing it. So exactly. So these two factors are correlated with the central bank, which really understand how the economic moves in the markets. So let's have the next one. So when you're talking about all the fundamental things where we're going to show which market, which one impact the markets majorly on this financial market, which type of, which impact rate. So when you're talking the reasons, correlation and recent factors which are the markets have been affecting here, which is the coronavirus developments. If recently we are facing last 3 or 4 months from January, from 1st of January, the corona COVID has a major role playing in the markets, which really it's one of the reason where market has been seen a lot of sell-off. Even you can see a lot of central bank selling bonds over there. So different things have been happening. So when it comes next, the tension between the China and the United States. Normally this has been there for a long time, but still even recently couple of days China has kept some ban on US for import. So these are the news, like, it's a flash news, it comes out with regularly basis. So which are the market which really impact the markets? We have to focus on very keen on about this type of markets, like for the news where really give the volatility in the market, sudden volatility, which can be entirely change the trend anytime. Even coming up like US president's election, which is going to be happen as of now, not been announced still, but it will be usually planned to come on November month, like coming year. So this is also a major expectation of the traders, where we're looking for how the US government going to change, how it's going to impact the entire US dollar dominance. So when it coming to the future of Brexit, yes, which has been discussing for many years, last 2-3 years, which has been giving a lot of changes, a lot of new terms and conditions have been changed with the European and the UK government. This also gives a lot of fluctuation because euro and pound act as a major currencies against the dollar, which obviously impact or obviously give the correlation with other currencies as well. So these also, there are major matters to be coming under this fundamental factors to how impact. And finally, we can see this OPEC outputs. OPEC oil has to OPEC how the output cut, production has been cut. So based on that, and few days like last 2 months, we have seen the oil has dropped drastically. And because of the Russian oil growth, they're not ready to cut their output. And later there was a OPEC meeting, confused. There were 2-3 confused meeting was there. Later there was slow cut is there. So now the market slightly bouncing back from 28, 26 to now move on to 36 or $37 per barrel. So these are the major impact. So fundamentally, which you have to look into is like, very carefully to monitor about the current affair of the markets. So as Wael was saying, there's a calendar available. If you say for today, there was a couple of important news were there in the markets where ADP non-farm employment change, which was really came better for compared to the prediction. It came better for US dollar. That's moved. Even stock was moving up, indexes was moving up based on that. Even ICM non-factor PMI was one of the important calendar report was there today, which was expected. It was good than expected, like it was 44.2, today came at 45.4. So these are the daily calendars available, daily indicators are there. So based on the news release at the time of release, and Wael was clearly explaining how to read the news. That's where forecast, there is a last report and actual. So based on actual report, the time, the markets keep reacting on it. So this was a small explanation about how exactly the market was moving. And we can see from the charts where the news is like how exactly the market reacted. Even I've taken just a 1-minute chart to show how exactly the market reacted for dollar impact. So there was a clear dollar fall. I mean, USD CAD, there's a big fall happen here after the news. So like this, if you take for each and every currencies like euro, or if you take for euro, USD, oh yeah, you can see the gold. Wow, this is how exactly after the market move. So really, see, technical is different and fundamental is completely different. So when you keep following up with the important indicators and what time of the market release, you can see the major movement happen. There's a big volatility happen in the markets. So this is how exactly we need to follow. It's just a basic about the information. Hope you'll enjoy it. And do you have any questions of any type? Please post on your questions here. We have to help you. Thank you.
Thank you, Sai, so much. So if you have any questions, please write them down so we can answer them. I would just like to remind you that all the opinions, analysis, news, and information mentioned in this webinar only serve for educational purposes and shouldn't be taken as a signal whether to buy or sell a certain financial instrument. So please, if you have any questions, write them down so we can answer them. Okay, someone asked if they can manipulate the news. Usually the news, they are they have certain sources. It's either governments, non-profit organizations, or universities. They do provide these news. So it's based on the credibility of the governments and then the sources. So based on these on their credibility, so mostly not so. It is always accurate. It should be accurate news. Yeah, for Australia and COVID-19, the country was like a role model in treating and dealing with the virus, and especially we have to look for something that China recovered fast. So we saw some indicators pulling back in China starting March and April, and this was faster than other countries. So and Australia relies heavily on the Chinese economy. So as soon as the Chinese economy was starting to relaunch or restart the economic activities, this was very beneficial to Australia, and we saw the Australian dollar rising against other major currencies. So it was the flow of money to Australia. It was behind the move that we saw recently. Sir, we can't give any advice regarding the market, as I mentioned, but if you have to look for the coming flow of the monies. The reason behind this rise in the Australian dollar against its pair, since investors and market participants, like big players, they saw an opportunity that the market, as I mentioned at the beginning, that those who follow fundamental analysis, they believe that the market is currently underpricing or having a wrong price for a certain instrument, a certain financial instrument, whether currency, a stock, or something. And going forward, the currency or the market will reprice this instrument and will give it the fair value. So this is what happened with the Australian dollar. We saw very sharp selling prior to the outbreak in the United States and Europe. We saw very sharp selling on the Australian dollar, first due to the actions by the central bank to cut interest rates to 0.25%, and also if you can remember, the Reserve Bank of New Zealand and Reserve Bank of Australia, they were both cutting interest rates before even before the COVID-19 outbreak. So also this had an impact on the market before the COVID-19. But however, when as you said, China started to move again, and those investors, they realized that the top partner for China is Australia, or the Australian economy relies heavily on China. And also since the demand for commodities, the steel commodities or metals, so which is a big part of the Australian economy, it was demand for these commodities were booming. Also, this led to higher demand for the Australian dollar. So it was all in all a positive scenario. Yeah, hopefully we're starting also another series of educational webinars in Arabic. Hopefully next week or the week after. We still didn't set a timeline, but hopefully next week or the week after we'll be promoting the events. And if you need any support, also you can contact us or contact your sales representative and ask for a one-on-one training session. We can give you one in Arabic if you want. Any further questions? Okay, perfect. So I believe that's it for today. Thank you for joining. Sai, would you like to add anything?
Thank you so much for your time, everyone.
Okay, thanks everyone again.